The U.S. government is suddenly asking Congress for an extra $200 billion to fund a new military conflict. When asked by a reporter if the administration would raise taxes to pay for this, the Treasury Secretary laughed it off. He called it a ridiculous question and claimed the government has plenty of money. That claim directly contradicts the mathematical reality. If the Treasury had surplus cash sitting around, the government wouldn't be running massive, multi-trillion-dollar annual budget deficits. When Washington refuses to raise taxes or cut other spending for a $200 billion expense, the bill doesn't disappear. The cost is simply shifted out of public view. The true state of the nation's balance sheet is anchored by a $39 trillion national debt. The Treasury is entirely out of surplus cash. To find $200 billion, the government has exactly two options: borrow the funds from global investors, or have the Federal Reserve print new currency. Creating new money to buy bombs and missiles increases the total supply of dollars in the economy. Because no new wealth was created to back those new dollars, the purchasing power of every dollar already sitting in your bank account goes down. Citizens still pay for the war, but instead of writing a check to the IRS every April, you pay the exact same cost through the invisible mechanism of currency debasement. During World War II, the government used the victory tax. They explicitly raised income taxes and introduced paycheck withholding to directly cover military costs. A direct tax is economically honest because the public sees the exact cost of the conflict on their pay stub. But a direct tax is politically disastrous, causing a war to lose support the moment people realize they have to foot the bill. Deficit spending is the modern political alternative. It means taking on the expense today and permanently adding the cost to the national debt, rather than billing the public up front. This allows politicians to wage expensive conflicts without facing voter backlash. The leaders get their funding, and the middle class silently absorbs the financial hit through inflation. To see this hidden tax actively draining the economy, we look past the heavily adjusted consumer data and examine the raw underlying numbers: import and export prices. This chart plots the raw price index for February. Import prices shot up by 1.3%, and export prices jumped by 1.5%. Projecting this steep trajectory over a full year compounds to an annualized inflation rate of nearly 17 to 20%. Domestic manufacturers have to buy these raw materials to create goods. When their costs jump nearly 20%, they cannot absorb the loss to their profit margins. They pass every cent of that increase directly down the supply chain to the buyer. These double-digit increases in raw materials guarantee a massive, unavoidable surge in everyday consumer goods over the coming months. This inflation chain reaction strikes the domestic housing market almost instantly, collapsing the volume of mortgage applications. In a single week, the composite index for mortgage applications dropped 10.9%. The very next week, it fell another 10.5%. As inflation surges, lenders demand higher mortgage rates to compensate for the depreciating dollar. Those higher rates immediately kill the ability for current homeowners to refinance their existing debt. The hidden inflation tax drives up the cost of home maintenance, utilities, and insurance while pushing mortgage rates out of reach. This forces real estate values down and traps middle-class homeowners underwater. The economic data shows that severe producer price inflation and economic weakness were already locked into the system long before the current conflict started. A geopolitical crisis offers a highly effective tool for political leaders: the scapegoat economy. It provides a sudden, heavily publicized distraction from pre-existing domestic policy failures. When the data worsens, leadership can point to the foreign conflict. Spiking prices and rising unemployment are reframed as necessary sacrifices for national security, rather than the mathematical result of unchecked deficit spending. The conflict isn't the root cause of the economic crisis. It serves as a convenient smokescreen, protecting politicians from the consequences of printing trillions of dollars. The financial reality facing the public is the deliberate, ongoing destruction of the US dollar's purchasing power. The greatest threat to American prosperity is not a foreign adversary. It is the unchecked deficit spending originating directly from Washington, D.C. Protecting your purchasing power requires moving capital into hard assets. Commodities like gold cannot be printed, debased, or manipulated by political decree. As long as Washington funds its ambitions through stealth inflation rather than honest taxation, true financial stability requires stepping entirely outside their debt-based system.